So, Greg, I'm going to start off with you. A lot of people are looking forward to the big jobs report coming up at 8:30 this morning. A lot of pressure, a lot of thoughts about that. But you're actually looking past that to next week, to our next CPI print. So I want to ask you about both, if you don't mind. How do you see the jobs report impacting the market? And then what are you looking for in that CPI print next week?
Right. And I think you intimated probably what I think, Frank. The jobs report, unless it's on one of the extreme or the other, is likely a non-event. At this point, with around 2 million more jobs than willing workers, with our lowest benefits being taken in 50 years, the Fed's hands are really tied unless there was a cratering in employment, which it doesn't seem is on the horizon. Largely, they forced themselves into this by being behind the curve on combating this inflation. There were many of us who thought they should have come out of Jackson Hole with a plan to start tightening last year. They didn't do that. And so at this point, their hands are largely tied. But the next CPI print may indeed be a big event. At the end of the day, we're going to have to start talking about the base effect again. And you may remember that this was a very popular phrase in 2021 for those who were in that transitory camp and nothing to see here in inflation. But it's now working the other way. Last month, we put up 8.5% on a March 2021 of 2.6%. But April of 2021 is when we started to move past the 4% level on CPI. We put up 4.6% in April 2021, 5% in May. And so this is going to be very binary. If we continue to put up 8% plus, I think that the environment is more deleterious than even I thought. And recall that I'm thinking that fair value on the S&P is somewhere below 4,000 at this point. And if we come in with 200 or 300 basis points below where we were last month, I think that will breathe a short-lived relief rally into the market, a market so desperate for any whiff of good news at this point. Folks will probably ignore the base effect at play, and those who have said that inflation was peaking get to be right and take that victory lap.
So, Dan, I want to come over to you. If we're going to see a relief rally, tech was going to have to be a big part of it. You actually believe there's a potential bounce for tech coming up, but obviously, we have a lot of concerns about rates, inflation, et cetera. What areas of tech do you see having that bounce? I know you think that just throwing a dart at FANG stocks and hoping for gains, that trade's over.
Yeah, I mean, if you look at, you were talking about the CPI data in terms of the impact that it has on market valuations. I think what we're seeing now is, in terms of inflation being very high, which historically means we have very low PE ratios on the market. And I think that's what's really hurting tech right now. But there are some areas of strength. If you look at, for example, the rollout of 5G, you look at artificial intelligence, you look at the movement towards data center. A lot of the things that have been brought out in the last week or so are well documented. We know that we're seeing a slowdown in terms of social media spending. We saw that with the Google numbers. We saw that with Meta, Twitter, Pins, all those numbers, Snap. But there are still pockets of strength. So I think, tech isn't completely wiped out. I just think we're seeing a reevaluation because of concerns about PE ratios. That brings down, inflation bringing down the PE ratios. And of course, most of the tech stocks trade at very high multiples. So I think that's what we're seeing right now in terms of the impact on tech. But tech isn't completely dead. There's still sectors that are expected to do very well.
Yeah, speaking of tech, Greg, I want to come back over to you. You're actually looking at one very specific area of tech, fintech. I know we don't usually talk about Visa, MasterCard, and Amex as fintech, but they really are fintech stocks. And you believe there's a lot of upside to them just because of our, general reopening and travel trends, even if there is a recession?
Well, I'm going to follow on with what our colleague just said a little bit here, Frank. At the end of the day, this is an environment where we're not going to get multiple expansion. And in an environment where you can't count on multiple expansion to drive performance, you have to look at where the earnings growth is. And so Visa and MasterCard have been putting up 20% plus top line and 20% plus bottom line. The key catalyst for me turning positive about 6 months ago is I was looking for a return for those cross-border transactions, and that came through in blaring fashion in the last report. I was looking for a return of travel and entertainment spending. That came through in blazing fashion this last quarter. But there are other areas where you can get that double-digit top line and that double-digit bottom line growth. And even within big tech, you're going to have to differentiate. There's a difference between an Apple growing at mid-single digits and a Microsoft growing at 20% top line and putting up 20% bottom line. And as you look for safety, that's where you can find some relative performance in that sustainable earnings growth.
So Dan, back over to you. I want to actually bounce off one of Greg's initial points. He's looking forward to the CPI, not the jobs report. I don't know if you believe it's going to be a non-event either way. You can answer in a second. But if we get that CPI report and we don't see any decline in inflation, or if it ticks up, that's going to raise some concerns about economic growth. Will we continue to see this slide when it comes to tech stocks?
I think so. I mean, as we mentioned before, the inflation number is absolutely key because, you know, we had these conversations, Frank, a year ago, and everybody said that inflation was going to be transitory, right? We know the Fed has a toolkit, things they can change in terms of slowing down inflation. They can't change oil prices. They can't change shortages. So inflation could stay elevated for a sustained period of time. And again, a lot of these tech stocks do trade at very high multiples. I think the average P/E ratio right now in the NASDAQ is about 41 times earnings. So again, you have this compression associated with times of high inflation. If you go back and look at the 1970s, the average P/E ratio on the S&P 500 was about 10 times earnings because we had very high inflation. So there's no doubt, Frank, that the CPI number is absolutely critical, not only in terms of how it impacts P/E ratios, but the concerns that inflation will eat into growth going forward, which then slows down IT budgets in the enterprise space, and that hurts tech. But I will say this, Frank, I've been in the business for over 30 years, and I don't think we're anywhere close to where we were back in the summer of 2000 when we had the tech bubble. There's too many underlying strengths within technology right now. I just think that we're going through a period of reevaluation.
Dan, really quick, we're almost out of time. Can you just give us, Greg was nice enough to give us a few names, stocks. Any stocks you're especially bullish on in that tech area?
Well, tech right now, I think I would focus on the names that were mentioned earlier. I mean, Apple's one of our major holdings. Also, Microsoft continues to be very interesting because they've been able to accelerate their top-line growth. NVIDIA, which will report in about a month from now, they should continue to do very well in the data center and the gaming space. So these would be stocks for your viewers to look at if they have the right investment objectives and tolerance. But those are some names that we currently have on our buy list.